The most powerful blockade in a modern shipping crisis may not start with a chain across the water. It may begin in an insurance office, when the price of risk tells a firm that a voyage no longer makes commercial logic. Bab el-Mandeb sits at the southern mouth of the Red Sea, linking the Indian Ocean with the route towards Suez and the Mediterranean. Its geography is straightforward enough to draw quickly. Yemen on one side, Djibouti and Eritrea across the water, the Gulf of Aden below, the Red Sea above. Its strategic behavior is much harder to draw because the pressure passes through ships, crews, insurers, ports, navies, and schedules at the same time. If vessels feel unsafe near this strait, the disruption doesn't stay near the strait. It can spread into container rates, delivery times, fuel demand, port congestion, and the balance between Asian manufacturing and European consumption. That is what makes Bab el-Mandeb different from a local security event. It is a narrow place where regional conflict can enter the bloodstream of world trade. The first channel is fear priced into movement. A ship owner doesn't need to wait for a formal shutdown if the crew risk, hull risk, cargo risk, and delay risk become too high. War risk premiums can climb, schedules can be shifted, and vessels can be ordered around the Cape of Good Hope even while the waterway remains physically open. That is how a route can be open on a chart and partly closed in practice. That decision is made vessel by vessel, insurer by insurer, company by company. No single announcement has to arrive. The second channel is distance. One diversion around southern Africa adds time, fuel, crew demand, emissions, and vessel capacity pressure. A container ship that spends longer at sea isn't available for the next sailing on the same schedule. Multiply that across enough voyages, and the system needs more ships just to maintain a slower service. This is why a choke point disruption can tighten shipping capacity without sinking a single vessel. The third channel is reliability. Modern supply chains are built around expected arrival windows. Factories, retailers, ports, and inland transport networks all plan around the assumption that sea routes behave within a tolerable range. If the Red Sea route becomes uncertain, the disturbance spreads into warehouses, rail yards, trucking contracts, and inventory decisions far from Yemen. That public often hears about the dramatic part of the story: missiles, drones, naval escorts, explosions, and warnings. But the business end of the crisis is quieter. It remains a scheduling department rewriting rotations. It remains a cargo owner choosing between delay and cost. It is a port watching arrival bunching because ships that took longer routes now appear in uneven waves. It is a shipper explaining why the fastest route on the map is no longer the safest route on the balance sheet. This is the practical power of Bab el-Mandeb. It doesn't need to control all shipping to shift the behavior of enough shipping. That strait is also tied to Suez. When Bab el-Mandeb feels risky, the northern shortcut through Egypt loses part of its usefulness because access to that shortcut depends on the southern entrance. One canal can be perfectly maintained, but the approach to the canal can still shape its traffic. That is one of the oldest lessons of choke point strategy. The gate is only as reliable as the route leading to it. Navies can reduce risk, but they can't erase the commercial calculation. One escort can protect a vessel in one segment, but it can't guarantee the entire political environment around the route. One missile defense success can reassure the market for a day, while a new attack can undo confidence the next morning. Maritime security is therefore not a switch. It is a confidence curve. Governments try to push that curve upward. Insurers and shipping lines decide if it is high enough. The human layer matters too. Crews aren't abstract inputs in a freight model. They are people asked to travel through a danger zone, and their safety concerns get pulled into the cost of using the route. One company that ignores crew risk may save distance but lose legitimacy, staff trust, and insurance confidence. That strait also exposes a gap between military power and commercial patience. One state may be able to patrol, intercept, retaliate, or escort, but commercial traffic still asks a different question. Will my voyage be predictable enough to be worth the route? That question isn't answered by firepower alone. It is answered by repeated safe transits, stable rules, credible communication, and the absence of surprises. That is why partial return to the Red Sea can be cautious even after the security situation improves. Companies may test the route before restoring normal schedules. They can send some ships and hold others back. They can wait for insurers, customers, and crew policies to align. The route recovers not when a headline declares it recovered, but when enough operators believe the pattern has shifted. Bab el-Mandeb also gives regional ports a complicated role. Djibouti, Jeddah, Aden, ports along the Gulf of Aden, and facilities around the wider Red Sea get pulled into the adjustment network. Some benefit from altered flows or military attention. Others suffer when mainline services skip the area or costs climb. That same disruption can produce opportunity for one node and pressure for another. This unevenness makes the crisis harder to summarize. There remains no single global effect. There remains a chain of effects, and each link absorbs the shock differently. For consumers, the most visible consequence may be delay or price pressure. For firms, it may be inventory planning. For governments, it may be a strategic reminder that sea lane security isn't an abstract naval doctrine. For Egypt, reduced Suez traffic can mean revenue pressure. For Europe and Asia, longer routes can mean slower exchange and higher transport intensity. For the wider system, the lesson is that trade depends on trust in places most customers never see. That future of Bab el-Mandeb will probably not be defined by a single permanent closure. It will be defined by cycles of confidence and hesitation. Every incident, patrol, ceasefire, warning, and successful transit shifts the calculation a little. This makes the Strait a pressure gauge for the global economy. If confidence climbs, the shortcut comes back into view. If confidence drops, the Cape route becomes more attractive despite its cost. This isn't only a story about one narrow waterway. It is a story about the invisible institutions that decide if a waterway is usable: insurance, classification, crew policy, naval coordination, port scheduling, and customer tolerance. To understand Bab el-Mandeb, follow a single voyage through the decisions made before the ship even reaches the danger zone. The owner weighs the cargo value, the flag state, the charter contract, the crew policy, the insurer's conditions, and the customer's tolerance for delay. That route decision is therefore made in layers. One navy may say the lane is being protected. An insurer may say the premium has to rise anyway. One customer may say the cargo is late if it goes around Africa. A crew manager may say the company has to avoid unnecessary danger. Every answer is rational inside its own responsibility, and together they produce the route's real status. That is why the waterway can appear open while normal traffic remains hesitant. Commercial confidence returns by accumulation, not by proclamation. One successful transit matters. 1 week without incidents matters. One clear warning system matters. One credible ceasefire matters. But one serious attack can reset the calculation. That route's recovery therefore resembles a market rebuilding trust after a shock. That geography is fixed, but confidence has to be earned again. The Cape diversion reveals how expensive distrust can become. Ships that sail around southern Africa burn more fuel, spend more days at sea, and disrupt rotation schedules across entire services. A company operating weekly container loops can't simply stretch every trip without consequences. More vessels may be needed to maintain the same frequency. When those vessels aren't available, service reliability declines. When reliability declines, shippers build bigger buffers or pay for different arrangements. That effect spreads without needing a single dramatic bottleneck image. Ports see it through arrival bunching and skip calls. Manufacturers see it through uncertain delivery dates. Retailers see it through longer replenishment windows. Consumers may see it later, through price pressure or slower product availability. That is how a narrow strait talks to a distant warehouse. That message travels through time, cost, and uncertainty. Suez is part of the same mechanism, but in an indirect way. The canal's value depends on the safety and predictability of the approach route. When the southern access is risky, the northern shortcut loses some of its commercial advantage. This turns Bab el-Mandeb into a gate before the gate. One route can be vulnerable not where the canal walls stand, but where ships decide if the canal is worth approaching. That military response also has limits because shipping is a civilian economic system. Warships can intercept threats and reassure operators, but they can't command a private company to accept commercial risk at a price the company rejects. That boundary between security and commerce is therefore crucial. States manage threat. Markets price confidence. If the two don't align, traffic remains cautious. That doesn't mean naval protection is ineffective. It means protection has to produce a pattern reliable enough for commercial behavior to shift. One single safe convoy is encouraging. One stable sequence of safe voyages is more persuasive. One clear chain of communication between navies, ports, companies, and insurers is more persuasive still. In a route like this, information is part of security. Unclear warnings, rumors, or contradictory announcements can lift risk even when physical danger has not shifted. One company making a route decision needs confidence in what it knows. If information is fragmented, the safer commercial answer may be to avoid the route. This avoidance is itself a form of pressure on the global system. That crew layer deserves more attention than it usually receives. Seafarers are often invisible in strategic analysis, yet their labor makes the route usable. If crews feel exposed, if unions object, if families worry, or if firms struggle to staff voyages, the route's economics shift again. Human risk can't be separated from maritime risk. The insurance desk understands that even if the public debate doesn't. Bab el-Mandeb also links local conflict to global inequality. Large firms may absorb higher freight costs or negotiate alternatives. Smaller importers and poorer economies have less room to maneuver. A route disruption can therefore drop unevenly across countries and companies. Some cargo moves late. Some moves at a higher price. Some may be postponed entirely. That same strait can be a strategic concern for great powers and a practical cost issue for plain businesses. This dual identity is what makes it so important. That route is military, commercial, humanitarian, and financial at the same time. One narrow view misses the pressure transfer. An attack doesn't simply affect the ship that is targeted. It influences every ship whose owner now asks whether the same risk might apply. This is how intimidation scales. It works through uncertainty, not through physical control of every vessel. The strongest countermeasure isn't only force. This is the restoration of predictability. Predictability lets insurers lower caution, lets crews accept assignments, lets ports plan arrivals, and lets customers trust delivery windows. One choke point can survive danger if the danger is bounded and understood. It becomes more damaging when the danger feels open-ended. That is the strategic lesson of Bab el-Mandeb. The route's power isn't that it can stop all trade. Its power is that it can make enough trade question its own assumptions. Once that happens, the costs begin to move around the world before the waterway is formally closed. This is why the phrase, open sea lane, can be incomplete. That better question is open for whom, at what premium, under what warning, and with what confidence tomorrow. That answer to those questions decides whether the Red Sea is a shortcut, a gamble, or a corridor slowly returning to use. That route's most important number may not be its width. It can be the cost difference between using the Red Sea and sailing around the Cape. That difference shifts as fuel prices, charter rates, insurance premiums, port congestion, and security expectations move. If the difference is small, caution can dominate. If the difference becomes large, firms feel pressure to test the shortcut again. This produces a rhythm of partial return, hesitation, and renewed diversion. The system doesn't behave like a door swinging open and shut. It behaves like a portfolio of route decisions under uncertainty. Some carriers may return earlier because their customers demand speed or their risk tolerance is higher. Others may wait because their cargo mix, crew policy, or insurer conditions make caution more attractive. That uneven return can complicate ports because services don't all normalize at once. That same week may contain a successful transit, a warning notice, a premium adjustment, and a route cancellation. For a global chain of supply, that mixed signal is difficult to price. Bab el-Mandeb therefore reveals why commercial recovery can lag behind diplomatic recovery. One ceasefire, a patrol announcement, or a reduction in incidents may improve sentiment, but shipping companies often need repeated evidence before changing schedules. That difference between political hope and commercial confidence is crucial. One government may want to declare the route safer. One shipowner may ask whether a crew and a cargo should be the test case. This isn't cowardice. It is the logic of risk management. That cargo market also divides the effect unevenly. High-value time-sensitive goods may absorb higher costs to protect delivery. Lower margin cargo may be more exposed to rerouting expense. Bulk commodities may respond differently from container services. Energy cargoes may face different security assumptions from consumer goods. One single strait can therefore produce several economic stories at once. This complexity is why slogans about reopening or closure are often too blunt. That useful question is which cargoes return, under which conditions, and how quickly the confidence spreads. When the answer is narrow, the route remains partially impaired. When the answer broadens, the Red Sea begins to recover its role as a major connector. Until then, Bab el-Mandeb remains a place where the price of risk can redraw the map faster than diplomacy can redraw the headline. There remains also a timing problem inside the return decision. One company that waits too long may pay more than its competitors, while a company that returns too early may expose crew and cargo to unacceptable risk. This competitive pressure makes route recovery uneven. It also means public announcements should be read against actual sailing behavior, because the ships themselves reveal confidence more clearly than statements do. That route also affects ship financing and charter behavior. One vessel committed to a longer voyage may miss the window for its next contract, while a vessel sent through the Red Sea may demand compensation for risk. Those private negotiations rarely reach the public, but they decide how fast traffic can normalize. That strait therefore shapes not only where ships sail, but how the market values a ship's time. Bab el-Mandeb matters because it proves that access isn't the same as confidence. One route may be legally open, physically navigable, and commercially avoided at the same time. This gap between open and usable is where the real leverage lives.